Hey everyone, welcome back to Corporate Decoder, the place where we unravel the hidden secrets of corporate filings. And this report from Impact BioMedical shows us some interesting financial twists and turns that definitely deserve a closer look. Get ready to dive into the financial health of a biotech company that has been navigating a complex path, with a recent IPO and some unique financial instruments shaping its balance sheet. We're looking at Impact BioMedical Incorporated's quarterly report, and it paints a picture of a company in transition, managing significant changes in its financial landscape. Let's kick things off by looking at the company's financial standing. At the end of September 2025, Impact BioMedical had total assets of about $18.2 million. That is a noticeable drop from its December 2024 position of over $20 million. What is driving this change? Well, cash and cash equivalents took a big hit, falling from almost $2 million down to just $12,000. That is a massive decrease and definitely something to watch. On the flip side, accounts receivable and inventory have appeared on the books this year, suggesting some new sales activity, though the numbers are still relatively small. The biggest chunk of their assets right now is in other intangible assets net, which is over $17 million. This usually means things like patents and intellectual property, which is key for a biotech company. However, the value of these intangible assets has also decreased slightly from December 2024. Now, let's turn to the liabilities. This is where things get really interesting. Their total liabilities have jumped significantly from about $13 million in December 2024 to over $27 million by September 2025. A huge part of this increase comes from note payable related party, which has ballooned from just under $9 million to a staggering $22.8 million. This is a related party loan, meaning it is with an entity that has some connection to the company, like a parent company or a major shareholder. This increase in debt overshadows the growth in assets and leads us to the company's equity. And that brings us to the company's stockholders' equity, which has moved from a positive $7.2 million in December 2024 to a negative $8.8 million by September 2025. This means the company is technically in a deficit position. Its liabilities are greater than its assets. This is a pretty serious indicator that the company owes more than it owns, which is never ideal. Let's see how the company performed operationally. For the 3 months ending the 30th of September 2025, Impact BioMedical reported a revenue of just $18,000. That is a big jump from zero revenue in the same period in 2024, which is a positive sign. However, when we look at the 9 months ending the 30th of September 2025, revenue is also $25,000. While any revenue is good, these numbers are tiny, especially for a publicly traded company. The costs and expenses, however, are much higher. For the 3 months ending September 2025, total costs and expenses were $966,000, and for the 9 months, they were over $3.1 million. This means the company is spending a lot more money than it is earning. This leads to an operating loss. For the 3 months, it was nearly $1 million, and for the 9 months, it was over $3.1 million. This indicates that the core business operations are not profitable. And when we look at the net income line item, we see a net loss of $1.4 million for the 3 months ending September 2025. For the 9 months, this loss widened considerably to over $17 million. This is a stark contrast to the net income reported in the prior year periods, which were significantly boosted by changes in the fair value of their related party note payable. This highlights how crucial that financial instrument was in their prior results, and how unsustainable it is as a primary driver of profitability. The company also reports a loss attributed to non-controlling interest, which represents the portion of ownership in their subsidiaries that they don't own directly. This indicates that even the parts of the business they don't fully control are contributing to the overall losses. Looking at the statement of changes in stockholders' equity, we can see the impact of these losses. The accumulated deficit has grown substantially. In December 2024, the accumulated deficit was over $37 million, and by September 2025, it had jumped to a staggering $54.7 million. This means the company has accumulated a massive amount of losses over its history, far exceeding any profits it may have made. By the 30th of September 2025, the total stockholders deficit is a negative $11.8 million, a significant deterioration from the positive $4.2 million in December 2024. This further confirms the challenging financial position the company is in. Now let's talk about cash flow, which is the lifeblood of any business. For the 9 months ending the 30th of September 2025, the company used $1.9 million in operating activities. This means their day-to-day business operations are consuming cash. This is worse than the previous year when they used about $1.8 million. The company is not generating positive cash flow from its operations. Investing activities provided only a small amount of cash, $2,000 mostly from payments on notes receivable. Financing activities offered no cash in the 9 months of 2025. In contrast, in 2024, they had about $4.5 million provided by financing, largely due to borrowing from that related party note and the proceeds from their initial public offering. This shows that in 2025, they are not raising new capital through debt or equity offerings to fund their operations. And the result of all this is a rapidly dwindling cash balance. At the end of September 2025, they had just $12,000 in cash and cash equivalents, down from almost $2 million at the beginning of the year. This extremely low cash balance is a critical concern and suggests the company might struggle to meet its short-term obligations. The company Impact Biomedical is focused on discovering, patenting, and developing new technologies in human healthcare and wellness. It partners with others to bring these innovations to market, covering areas like biopharmaceuticals and over-the-counter wellness products. They're aiming to tackle neurological, oncologic, and inflammatory diseases. Their business model relies heavily on licensing and co-development. One of their key technologies is Linebacker. This is a platform of molecules that show promise in fighting cancer, inflammation, and neurological issues. It is based on mericetin, a natural compound found in plants known for its antioxidant and anti-inflammatory properties. They have licensed 2 of these compounds to Prephase Laboratories, which could bring in future milestone and royalty payments if successful. Scrollatose soinstring, then there is Litose, which seems to have potential in reducing calorie and sugar intake, and also in fighting inflammatory diseases by inhibiting TNF. Alpha, the idea is that it can be used in foods or as a therapeutic to manage conditions like diabetes. Scroll functional fragrance formulation. 3F string, they also have a functional fragrance called 3F, which uses botanical ingredients like terpenes. This could be used as an antimicrobial agent or an additive in products like insect repellents and detergents. Global BioLife, one of their subsidiaries, is trying to commercialize this. Scrolliquiver, Guiver, G-string, finally Equiver G are blends of plant-based compounds with potential antiviral effects. These are also licensed to Prephase Laboratories, initially for upper respiratory wellness products. Scroll Note 2, Summary of Significant Accounting and Reporting Policies. String the company's financial statements are prepared using US generally accepted accounting principles. Or ASGAP, they follow the same accounting policies for quarterly reports as they do for annual reports. They also consolidate all majority-owned subsidiaries. Scrollers of estimates SUI string, like most companies, Impact Biomedical uses estimates and assumptions to prepare its financial statements. These affect how much is reported for assets, liabilities, revenues, and expenses. If actual results differ from these estimates, it could impact their financial reporting. Scroll Goodwill string, this section talks about goodwill, which is the extra value paid for an acquired company over its identifiable assets and liabilities. For Impact Biomedical, they had to record a significant goodwill impairment as of the 31st of December 2024. This means the value of the goodwill they had on their books was deemed to be worth much less than its carrying amount. The report states that the projected cash flows indicated an equity value far below the carrying amount, largely due to limited historical revenues and continued operating losses. This is a clear sign that a past acquisition did not perform as expected and led to a substantial write-down. Scroll intangible assets, string intangible assets like acquired technologies and patents are recorded at their fair value and are amortized over their useful lives. The company continuously reviews these assets for impairment. Scroll revenue recognition string. They follow a specific accounting standard for recognizing revenue from contracts. This involves identifying promised goods or services, figuring out if they are separate performance obligations, and then recognizing revenue as these obligations are met. Their revenue from selling technologies is recognized when the product is shipped. Scroll Note 8, Note Payable. Related party string. This is a critical note. The company has a revolving promissory note with DSS, a related party, for a substantial amount. As of the 30th of September 2025, the outstanding balance including interest was over $22.8 million. This note carries a variable interest rate tied to the WSJ prime rate plus a spread. What is particularly noteworthy is that this note allows the company to pay back principal and interest in either cash or in exchange for equity in the company. This flexibility, while potentially helpful, also adds complexity and risk. The company accounts for this note at fair value, and changes in its fair value are recognized in earnings, which can cause significant swings in profitability. As we saw earlier, scroll significant assumptions utilized in our analysis. String the company discusses the assumptions behind valuing this related party note. One assumption is that a change in ownership of 55% or more of the company's stock would be considered an event of default. They also outline how they've agreed with the lender that the loan could be settled by exchanging shares of the company's common stock at a specific valuation. This highlights the significant influence this related party transaction has on the company's financial structure and potential future equity dilution. Scroll note 10. Stockholders' equity string this section details their initial public offering, or IPO, which closed on the 17th of September 2024. They sold about 1.5 million shares at $3 per S-share, raising approximately $3.7 million after expenses. This IPO listing on the NYSE American under the ticker symbol IBO was a major event. They also mentioned stock-based compensation, where they issue options and warrants. On the 1st of October 2024, they awarded 880,000 options to officers, directors, and consultants. These options have a strike price of $3 and expire in 2031. The fair value of these awards, calculated using a model, was about $50,000. Stock-based compensation expensed in 2025 was around $5,000. Also in February 2025, they acquired assets from DSS Pure Air, a related party, paying with over 545,000 shares of common stock. And in September 2025, they issued 100,000 shares for legal fees related to a merger agreement. Scroll note 11, related party transactions. String this note details more dealings with related parties. DSS, a related party, has been passing through certain general and administrative costs to Impact BioMedical. These costs, primarily payroll for DSS employees, were about $21,000 per month starting in 2024 and increased to about $26,000 per month starting October 2024. For the 9 months of 2025, these expenses totaled around $238,000. Scroll note 15. Subsequent events. String looking beyond the reporting period, several significant events have occurred or are planned. Impact entered into a merger and share exchange agreement with Dr. Ashley's Limited, which is expected to close in the first quarter of 2026. This could fundamentally change the company's structure. More immediately, on the 16th of October 2025, DSS Biohealth Security, Inc. elected to convert its over 60 million shares of Series A convertible preferred stock into common stock. This conversion was approved by the company's board and audit committee. Also on the 16th of October 2025, the company converted its related party note payable to DSS into over 31.9 million shares of common stock. This means a massive debt obligation has been turned into equity, significantly impacting the ownership structure and potentially diluting existing shareholders. So, what does all this mean? Impact BioMedical is in a very transitional phase. They've completed an IPO, which is a huge step, and are bringing in new technologies and dealing with significant related party transactions. However, their operating results show a clear pattern of losses. The massive increase in related party debt and its subsequent conversion into equity is a major financial event. While it cleans up the balance sheet in one way, it also drastically changes the ownership structure. The company's decision to record impairment charges on goodwill signals that past acquisitions haven't performed as hoped. The tiny revenues, contrasted with substantial operating expenses and growing accumulated deficits, point to a challenging path ahead. That minimal cash balance at the end of September is also a red flag, suggesting they are heavily reliant on continued financing or asset monetization to stay afloat. The strategy appears to be leveraging intellectual property and developing new technologies, but the financial reality is that they are burning through cash. The conversion of debt to equity for the related party loan is a massive equity infusion, but it comes at the cost of significant dilution for current shareholders. This move might be necessary for survival, but it is crucial to watch how this new equity structure plays out, and if it can generate the revenue needed to support the company's operations beyond just covering expenses. Overall, Impact BioMedical is a company with promising technology and a recent IPO that has brought in capital. However, its operational profitability and the significant financial maneuvers involving related parties present substantial risks. Investors will be watching very closely to see if they can translate their technological potential into sustainable revenue and positive cash flow. Alright, that is our deep dive into Impact BioMedical's latest financial report. What do you think about these significant shifts in their financial structure and their path forward? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button, it really helps the channel. And of course, subscribe for more corporate investigations like this one. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching. and we'll see you in the next video.